Hello. In this video, we'll learn how to write a client letter. I'm actually going to go through with you, so together, we're going to actually write a client letter from scratch. Before we do that, let's just talk about some of the basics and some of the elements of client letters. Well, first, what is a client letter? A written communication of your research, of your tax research memo to the client. This is commonly referred to as a client letter. Now, there's different types of client letters. There's comfort opinions, there's FIN 48 opinions, there's penalty letters, all sorts of client letters. The main one when we think of client letters is a comfort letter written to a client on a closed fact pattern or an open fact pattern that the client is yet to contemplate completing. Now, the purpose of the client letter is to educate the client regarding the tax issue or issues and your research findings. Ultimately, the client makes a decision. It's their return. You as a tax professional, whether you're an enrolled agent, a CPA, an attorney, your job is to educate the client and tell them about the risks of certain positions. Because it's possible that you might come back to the client and say, you know what, this is an iffy. It could be viewed this way or it could be viewed the other way. And the idea is to bring this to them and let the client know, okay, well, here are the different risks and here are the different arguments associated. Now, if it's a very clear-cut opinion, as a tax professional, whether you're an enrolled agent, CPA, or an attorney, it's also your responsibility under the rules of professionalism to let the client know you must file this way or that way based on the facts provided. And we'll see that a little bit later in our memo, and I'll bring that up. Now, a form of client letter that expresses specific opinions is known as an opinion letter. Generally, the purpose of an opinion letter is to provide a taxpayer with an opinion supporting a particular transaction or tax return position that's being considered or has already occurred. So again, you're differentiating closed fact pattern and open fact pattern. The express intention of the opinion letter is to enable the taxpayer to fully rely on the opinions expressed in the letter. So that's what it's about. You provide this letter to the client. Basically, think about it. As a CPA, enrolled agent, attorney, you get the facts from the client and you perform tax research and you create an internal memo within your file for your business, for your firm, whatever it is. Then you have to communicate that to the client. Okay, so we have already written the memo. We've already done the tax research memo. Now we're communicating that with the client. Opinion letters are often issued in short form or in long form. Now, it's almost always the case that you're going to be issuing a short form opinion, and I'll talk about that in a little bit, why that's important. But there's times where a long form letter is necessary. A long form letter typically provides a well-reasoned analysis of the facts and applicable laws that form the basis for the opinion or opinions expressed. The short form just provides an opinion in most cases. That's what's used. Arguably, because your research findings are formalized in a written letter to the client, your legal vulnerability is at its highest when writing a client letter. So while writing a client letter can be very easy, especially after writing that memo, it's also a very difficult task because you need to be very, very, very careful what language you use. I'm going to talk about, there was a case called Canal Corp where it's an example of a bad situation where the client letter was not considered too much, and we'll talk about some of the things to avoid. But the idea is that while the client letter can be very, very easy task to do after doing that memo, it's also very difficult because you want to make sure that you have your risk minimization hat on. You do not want to state something in the client letter that the client fully relies upon a certain position when there's a chance where that position might not be the ultimate position that, let's say if it goes to court, actually the court rules in that direction. So you want to be very, very careful. Particularly with regard to opinion letters, it's often the case that third parties may also rely on the opinion. It's another situation why you want to have that risk mitigation hat on when you're writing these letters. Honestly, the biggest item, in my opinion, when you are writing a letter to a client, the most important thing to consider is risk mitigation. Because again, client relies on this, even other people can rely on this. So it's critical in these circumstances you perform a thorough and accurate research and craft a carefully written letter. In addition, you should always consider the below guidelines that we're going to talk about, below guidelines in this PDF, in terms of how you can lessen your risk and improve the quality of the letter. So drafting the letter. As I mentioned, we're talking about the client letter after you've prepared the tax research memo. If you have yet to prepare a tax research memo, go back, watch my videos, go look at the materials on how to write a tax memo. There's different tax memos that I go through, the basic tax memo, factors test. We're assuming that you've already watched all of those, okay? So the client letter should be composed using the general writing tips used when writing tax memo for internal firm purposes. So again, all those materials and videos that you should have gone through already, all those skills are still necessary for this client memo. They don't go out the door. Now there's going to be some differentiation here, big differentiation, the length, the style of writing, those things. And I'm going to help you. We're going to write it together. Don't worry. We're going to take a memo I wrote in a previous video and previous example where I went through with you, and I'm going to actually put that in the client letter format for you. So you will have an end product. And I'm not just going to, show you an example like some professors, some instructors do. I will actually write it with you. We will go into a Word document, a blank Word document. I will start with the addressor, the date, the addressee, the salutation. We'll go through all of it together. Do not worry. That will be covered in this video. Stay tuned in this video. Continue watching, okay? But before we do that, I want to make sure we're in the right mindset. So again, we've already completed the tax research memo, and now we are at the stage where we need to write to the client, okay? So again, that's kind of your starting point, is looking at that tax research memo. However, the language and the length should almost always differ. Like a good speaker, a good writer must know the audience before beginning. Because tax clients and their staff vary greatly in their tax expertise, it's an important element to consider the technical sophistication when comprising an opinion letter. So the idea here is, who exactly is your audience? Most clients out there, they're not tax savvy to the level of an enrolled agent, a CPA, an attorney, a tax professional. They don't know the tax jargon. They don't know specifically when you say, for example, the Golson rule. The Golson rule, if you don't know what that is, go ahead, stop the video, look that up. That's something that in the tax world we know about. And there's all sorts of, basis, things like that. Basis might be something that maybe someone that's not necessarily a tax person, but maybe a business person, they might have an idea about. Even things like long-term capital gains, because you have to give them some credit. But you don't want to assume they know all the technical expertise, like the Glenshaw Glass decision, especially court cases. You can't just assume that they know, oh yeah, this is a seminal tax case, they're going to know Glenshaw Glass. No, we don't do that. Now, there are certain things, and I'll talk about these later on, in the tax law, that's just what they're called. Like, for example, Code Section 1231, gains and losses. There's no other way to explain that. You can explain, okay, well, basically you have a Section 1231 gain or loss from the facts or from the information you provide me, and therefore it's going to give you preferential tax rate under long-term capital gains rates. You can explain that to the client, but you still have to say a Section 1231 gain or loss. If the client comes back to you and says, what does that mean? You explain, this is something under the tax law. That's the only way to describe it. Another thing is Section 1245 recapture. That's another element in the tax law where there's no other way to explain. You could say ordinary income, it's ordinary income, it's recaptured as ordinary income, or just say, oh yeah, the transaction will be treated as ordinary income. I wouldn't really put Section 1245 recapture in a client letter, but unless again the audience is a tax professional. But Section 1231 is an example where you could put that in a client letter because there's no other way to describe. There's no other way to describe it. You can, again, describe the ultimate consequences. That gets preferential treatment, but you still got to put Section 1231 in there, Okay, you still got to put section 1231. And you might be saying, well, why? The client ultimately, all they care about is seeing that it gets hit with a preferential tax rate. And you're right about that. But one thing is that occasionally clients, just like if you were getting medical advice or advice for your pet, you might go and seek additional advice from another professional. So if you do not put section 1231 in there, then the other professional would say, well, they say it's long-term capital gain, but actually it's a section 1231. So you got to be very, very careful, okay? It's like this fine line with the balance. You don't want to put in technical jargon and all of this information. You don't want a lengthy opinion letter because their time is precious. But at the same time, you do not want to leave out certain elements like section 1231 gain or loss where it can't be really defined any other way in terms of your analysis. So you see what I'm saying? It's a fine line, okay? Now I give some examples. Like, what if you have your client is a tax director. You're writing to the tax director of a large corporation's tax department. They're going to know tax jargon. But if you're writing to a CFO or a CEO that doesn't really have any tax knowledge, they just know finance and business, you got to be very careful. Okay, you got to be very careful. You can't mention Glenshaw Glass. You can't mention certain cases and stuff like that and assume they know what that means. Okay, the best solution though lies somewhere in between. That's where I provide the example of section 1231. You can't leave that out because I mentioned again, a lot of times clients, if it's a position they don't like, they'll go and seek a second opinion, or maybe they have a family friend, or they have a trusted attorney that doesn't necessarily practice tax, but that attorney does go look up the tax law. Maybe they have like a general business attorney that they deal with, and they're coming to you for a special situation. So you just have to be very careful. Except in the most unusual circumstances, client letters should not exceed 2 pages. I mentioned earlier short form, long form. If it's a long form, you can go over. Okay, you should try to keep the letter to 2 pages. It's even preferable to get it down to 1 page. It's very difficult when you're dealing with a lot of issues though to get just a 1 page, especially when you have to put this CYA, this risk mitigation language, and put information about the facts in there. It can get difficult. Now, there's a lot of facts, there's a lot of stuff going on. Of course, go beyond 2 pages. But you also need to be mindful that the client, their time is even more precious than even when you're a tax staff writing to a senior partner at your firm. So you need to be very, very careful about that. Okay, so this is really important. Format and steps to follow. Again, we're about to get into, in a few minutes, we're going to actually write a client memo or client letter. If I keep calling it client memo, I apologize. It's not a client memo, it's a client letter. We're going to use the memo, the tax research memo that we've done in a previous example, previous video, to draft a client letter. Before we do that, I have some steps. I have 7 steps, and there might be additional steps depending on if you're taking a tax research or writing class, but the ones I go through. I have the 7 steps that every client letter should possess, and you want to do these in order from the top to the bottom of a client letter, okay? So first step, step 1, is to have an addresser, a date, addressee, and salutation. So basically, it's self-explanatory. The top of the letter, in the middle, or formatting up to you, but you want to have the addresser. You're the addresser, you and your firm. Then you want to have the date. Then you want to have the addressee. That's going to be the client, and the salutation, dear Mr. Client. Okay, so that's step 1. Easy enough. Step 2 is you want to state the objective and scope of the research. Okay, you also want to state the agreement, what exactly your firm is doing for the client. This is important because if you're ever potentially, and again, risk mitigation hat here. I'm not trying to play, negative, not trying to be negative, but risk mitigation hat here is what you have on. If something ever happened where you were getting sued by your client, you want to restrict through this writing, through this letter, so that you can bring it before the court as evidence that you were tasked with doing X. That's all you were doing. You were being paid by the client to perform X task. If they object to something in the letter, then they need to send you something back, or they need to contact you and say, no, I wanted you to research this and draft the tax return, or I wanted you to research this issue and that issue, or I want you to research this and you state the facts, but actually the facts are this. That's going to be very, very important in the client letter. That's actually the biggest thing in the client letter in terms of, again, risk mitigation, you want to state what exactly you've done. You want to state the facts they provide to you. You want to state what exactly you found, and you also want to state the disclaimers required by law that, only the client can rely on this, do not use this in any other way, those types of things. That's basically what the client letter is all about. You want to basically put restrictions, okay? Now, at the same time, again, it's basically a legal mitigation, a risk mitigation document. But at the same time, you want to seem cordial and friendly. So when we write this letter later, I'm going to use language that makes it sound like, okay, I put in like some, you might call it fluff, but it's important. It's basically client relations PR. You want to ensure, okay, if you just made this very dry, harsh document that just, has all this legal liability, there are times where I've heard of tax preparers, tax professionals that have prepared these letters, and just the relationship, because it's just so dry and so harsh, in the future, that was a big element of why they lose a client in the future. There might be other reasons, but it's one of the elements, one of the factors, okay? So you want to obviously put some, we'll call it fluff, even though it's important because it is, public relations, client management, you want to please the client to ensure the client, like, listen, so they get a tone that, like, listen, I have to put this in here for legal purposes, but at the same time, please feel free to contact me anytime, whatever I can do to help you, that type of language. So step 2 is the objective and the scope of research. Always, always, always start a client letter with a statement about what you understand the client has asked you to do. You should also acknowledge the agreement of the parties to complete the project. So you have to acknowledge, and that's also another important reason is so you get paid. You want to state that in there. While another issue, we could have a whole nother video on preparing contracts between clients and the preparers or the professionals, tax professionals. If you put this in there, if there ever is a dispute and the client receives this letter and they don't ever object to it, but what you say about, okay, this letter confirms the agreement in which our firm agrees to do these services for you at this price, or just, you don't have to put the price in there, but our firm agreed to do X for you. You basically are saying, like, okay, well, we've already agreed that there's a contract in place for doing the services. So again, it's another way to go about that. So you should have that in the information, okay? And by the way, under each of these steps, unless they're self-evident or self-explanatory, I give a little example. And these examples are the actual ones I'm going to use when we write later, okay? But I will write them from scratch. I'm not going to copy and paste that language. I will literally write that language from scratch with you. I prepared this. I created this document, and you're welcome to use it. And if you're taking my class, you're welcome to use the same language. Don't feel like it's plagiarism, because I want this to be helpful to you. As you can see, it's kind of boilerplate where you can fill in the items. Of course, you want to adjust it. Not everything here is going to be perfect. And for those of you out there in practice, if you need to write a client letter and you need something to go off of, you're welcome to use this as well. I'll throw out the caveat for those in practice that are using this with actual clients. Just remember that, to follow all the IRS regulations and Circular 230 and all of those important things. Don't rely solely on my items for, doing your practice. Make sure that you research everything. But if you want to use this as a starting point, that's fine, okay? So we're going to put an objective and scope of research paragraph where basically we're going to talk about the objective, what we're doing, and also the agreement between the client and the professional, what's going on. So if you are doing a tax research project, you are going to state, okay, that this letter confirms the agreement in which our firm agreed to determine the tax consequences of this transaction. This letter also reports the preliminary results of our investigation into the tax consequences of, and again, the transaction. And then again, as I mentioned earlier, you want to have the fluff language throughout the presentation, throughout the letter, that basically says, hey, we're here to help you. We're pleased to be of service to you. Anticipate that our relationship will prove to be beneficially mutual. Please feel free to call upon me anytime. Some of you out there are like, well, that's just a waste of time. Again, it's a way to make the harshness seem not as harsh, to kind of, I know it sounds bad, but like kind cherry coated or a chocolate coated in chocolate, right? Make it a lot less harsh. Okay, so that's step 2. Step 3, statement of facts as presented by clients. So you want to basically go through and you want to take as much space as you need. And you want to hash out the facts and you want to hash out the material facts. The client gives you, pages and pages of facts, and they're only asking about a certain transaction, and only, let's say there's 3 pages of facts, and only, half a page of the facts actually matter to the transaction. Put just those half a page. Now, if the client comes back and they say, well, yeah, you say this, but there's also this other information, you're welcome to clarify verify the information that you have is still correct. The key is that you don't want to leave anything out, or you don't want to take a fact or say a fact that's not correct, that's incorrect, that led to your research and assertions. That's basically the idea. Okay, this is very, very, very important. Okay, this is a huge element of the client letter, is doing this. It's huge. So what I tend to do is, again, make this easy for you. Make it easy for you. Go to your tax research memo, copy and paste the facts that you've taken from your tax research memo, put them into the letter. Because remember, when you write the facts for your tax research memo for your for your internal file, those facts should be the only ones that are important to the events anyways. So copy and paste them over, but of course you need to edit them to make it seem more like it's directly to the client. You don't want to say, you're writing to the client, Mr. Client, and you say, Mr. Client in year 5 did this, right? Like you would in the tax research memo, those facts. So the idea is that you want to rewrite it to say, you did this, you did that. As I understand it, you did this. As I understand it, you did that. So you want to make it in those terms, and we'll do that in our example later on. That will be the only point in the client letter that we draft from scratch where I copy and paste something. Because again, I highly, highly, highly recommend, that you've already done this. You've already done this step. You've already figured out which facts are important for the research. So take those facts from your tax research memo, paste them into the client letter, put a statement that says, our conclusions are based on, an understanding that, and then state all the facts. And you also want to put a paragraph that basically says, before I jump into the facts, before I jump into the results, I just want to go through the facts. And I want to, and also explain to the client, because sometimes clients are like, why are they doing this? I already gave them the facts. Why are they giving me the facts back? This is again going back to that fluff. You want to restate briefly all the important facts as we understand them, as your firm understands them, as you understand them. And you also want to state, please review the statement of facts very carefully. Our conclusions depend on a complete and accurate understanding of all the facts. If any of the following statements is either incorrect or incomplete, please call it to my attention immediately, no matter how small or insignificant the difference may appear to be. And I have an example where I say that language. Then you want to start by saying, our conclusions are based on understanding that, and you go through the facts. That's where you copy and paste the facts from your tax research memo. And again, you edit those facts to make it seem like it flows better for the client, the style of that letter. Okay, the next part is the general summary of the research project results. And I talked about this a little bit already, but let's now get into it. So after you go through the facts, then you want to basically get into the conclusions. You want to get into the conclusions of your research, okay? So this portion of the letter focuses on what you found through your research. If you found that the client has more than one option, communicate each of those options with any risks that might be involved. Be careful though. Clients, again, do not want you to write a really long novel, and that's why, again, generally you want to keep this to 2 pages, again, unless it's like a lot of information, a lot of stuff going on. The client doesn't want, if we've talked already in the tax research memos of, making it concise for your superior, whether it's a senior or a senior partner at a firm, shareholder, you want to make that concise. You want to make this even more concise, because clients especially can get upset, if you just spew out all this information. The client wants to understand, the information, and they want to feel like, if they're paying a fee, they want it to be short, they want to understand everything, so you need to make it really clear, and you want to make it shorter in that regard, okay? Again, your purpose in the client letter is to educate the taxpayer. Now, remember also that the main thing about the client letter is mitigation of risk. This does not require, by educating the taxpayer, you're not required to put everything down in the letter. You can put the gist of what you found, again, stating the facts, so that's so important, because you need to put that in writing in case there was ever any type of dispute where it went to court or you're being sued for malpractice issues. You want to state all that. You can always just put in there at the end, like, okay, well, if you want to talk about this more, why I came to this conclusion, let's talk over the phone. That's usually what most tax professionals do. And by putting it through phone or through email, usually phone is what happens, or let's come in and talk in person and talk about these things, and I can actually show you the client file. It also alleviates some of that risk. It also reduces some of that risk because now you don't have it all in writing. Okay, you don't have it all in writing. Okay, well, you're like, well, I thought putting everything in writing is important. Yeah, you have your own file internally, right, to keep track of things. That's, again, going back to the tax research memo. But also, think about what you're providing to the client. You do not want them to take something the wrong way. You want to ensure that the client, again, it's short, it's concise, they understand everything, and you don't want to overload them with information, okay? Now, use language a non-tax person can understand. This is very, very important. You don't really want to avoid, you want to try to avoid citing code sections and cases. I talked about that earlier. However, there are some items where you probably do need to refer to them by the section. Perfect example is code section 1231, gains or losses. Perfect example. But let's say you had code section 1245, recapture. You could just put ordinary income. You could explain, it comes from depreciation or whatever, and even that's kind of questionable. Again, depending on what type of client it is. If it's a business client, they understand depreciation. But if they have no business understanding whatsoever depreciation, that might be it might confuse them. So the best thing to do is to provide, I give an example, assuming the preceding paragraphs going through the facts represent a complete and accurate statement of all the facts pertinent to, and you talk about summarizing what the event is, whether it's the sale of property, whatever it is, sale of land. We anticipate reporting that event as a long-term capital gain or loss, or a section 1231. So if you say anticipate, you do anticipate if the transaction is open, okay? So in this example, I use an open transaction. You would say it would be reported as an event if it was a closed fact pattern where the facts have been closed. So that's what we mean when we say we anticipate reporting. That would be, okay, well, if the client is considering an open transaction, like the facts are not yet finalized, they're a proposed transaction, okay? And then also what I like to do, in other words, and I will summarize it, and that's what I put in the layman's terms. So we anticipate reporting the event as that's the conclusion, and then in other words, I go through just a very, very, very quick understanding under layman's terms of what it is. So for example, property transactions, a big area. I will say that, okay, let's redo the paragraph. Let's assume that the taxpayer is selling land. Assuming that the preceding paragraphs represent a complete and accurate statement of the facts pertinent to selling of the land in year 5, we anticipate reporting that event, or let's say it already happened. The event should be reported, or this results in a long-term capital gain. In other words, you want to say this results in a long-term capital gain of, and you put the amount, whatever the gain is. I forgot to do that. So you want to obviously put the amount too. In other words, you will be getting this gain will be taxed at preferential rates rather than ordinary rates, such as rates on wages and business income. You want to put something in there that explains to them why long-term capital gain is important. They might have heard about long-term capital gain. You want to put something in there that basically, in layman's terms, that they know about. Most lay people know about, okay, there's different tax rates. They don't know exactly which tax rates apply to what, but almost all of them that know that there's different tax rates for certain transactions. So you want to explain, and you want to use examples that we all can understand, like business income and wages. If you have a business owner, business income. If you have a wage earner, wages, like, okay, well, maybe they're a medical doctor. They get a W-2, they're an employee. They know, okay, well, they get paid a lot on their wages, okay? Now, if it's favorable for the client and against the IRS, you also want to put something in there, and again, if it's something that could be disputed by the IRS, you want to include there is a possibility that the Internal Revenue Service could argue that it's actually considered ordinary income, and explain why. Because it might be treated as inventory to you. If you desire, be pleased to discuss these matters in greater detail. Now, if you're researching something that's in line with what the IRS would argue, for example, if you said this was ordinary income because it was inventory, you wouldn't need to put that in there. You would just put, if you desire, I'd be pleased to discuss these matters in greater detail. So if you're giving the client a result that would be contrary to what the government would want, or contrary to the other side where there is an argument on the other side, then you would want to have this Internal Revenue Service paragraph in there, just because, again, risk mitigation. It's all about risk mitigation, okay? So you're going to see an example later on, which comes from a previous memo that we did together in a previous video. We actually end up having ordinary gain on the sale of land because it's treated like inventory. So that would be in line with the IRS. The government would prefer an argument rather than long-term capital gain being treated as investment property. So you're going to see I'm not going to use that language. I'll mention it. If this was long-term capital gain, I would put, there's a possibility the Internal Revenue Service could argue, and I would explain. I'm not going to actually write that in the memo, but I'll say that, okay? And again, remember, you should have throughout your client letter that if you wish to discuss this further, let's set a time to meet or let's talk over the phone, because that's usually where you will talk to your client about these things in more depth. If they're willing to consider those things in more depth. A lot of times they're not, they're just going to take your advice, okay? And then next is step 5, the closing, including references to any required follow-up meetings. So after summarizing the after summarizing the research, it's important to close the letter by allowing the client to follow up. Again, you put all this stuff in there. You put facts. You put what you understand the project and the engagement to be. You're putting, the results of your research. So you want to put something in there, basically saying, and again, you want that fluff language. Thank you again for selecting our firm for tax assistance. It's very important that you go through the letter, keep it confidential. We strongly recommend that you control access so you don't just let anybody see this. If you have any questions, feel free to request a follow-up meeting and we can take a look at the files together. We can talk over the phone, all these things. We look forward to serving you in the future. So that's what you want. Finally, step 6, we got 2 more steps. Finally will be the signature. Step 6 is actually the very bottom of the letter, and it is the disclaimer statement. So for those of you that work at accounting firms, law firms, tax firms, if you're an enrolled agent, whatever it is, tax preparation, a lot of times, and you'll see these on emails, your firm requires that you put something in there, a disclaimer statement. So we need to put a disclaimer statement in our letter as well. Now, if you're working at a certain firm and you have a disclaimer statement, just use their disclaimer statement because you need to be in line with your firm, okay? So use that disclaimer statement. I created one just for here, and you're welcome to use this, but again, don't rely on it fully. You can use it as a starting point. IRS regulations require us to advise you that unless otherwise specifically noted, any federal tax advice in this communication, including any attachments, enclosures, or other accompanying materials, was not intended or written to be used, and it cannot be used by any taxpayer for the purpose of avoiding penalties. Furthermore, this communication was not intended or written to support the promotion or marketing of any of the transactions or matters it addresses. So you just want something at the very bottom of the letter, and you want to make sure that's in there. And then finally, the signature. Self-explanatory, put a signature sincerely, and you put your name, put the firm name if you're on behalf of the firm, and so on. All right, so those are the steps, and we're going to use those 7 steps, and I will bring this PDF back up, and we're going through and writing our memo together. sorry, memo, when we're using our memo to write the client letter, I keep saying that. I apologize. Okay? Client letter. It's a client letter. Tax research memo, we use that to create the client letter. So we will use those 7 steps together later on. Now, in addition, in this, the additional limiting language, I have a whole area here of ways that you, because again, the main thing, the main hat you want to have on when you're writing a client letter is your risk mitigation hat. In addition to the risk mitigation, we already have so much in that letter. And again, you also want to be careful. You don't want to be too harsh, but you also want to be careful, right? You want to be careful and you want to protect yourself. If you need to have additional language in there, limiting your risk, I have some examples of areas where you might want to do this. Now, it depends on the situation. If you know something is likely to be very questionable by the IRS, they're going to, flag it, audit it, it could go before the court, then you definitely want to consider additional language. Also, if you have a client that is very, 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 jumpy, they're very, I don't want to, say the wrong thing about a client, but you just get that vibe from them that like they're very questionable, then you definitely want to think about extra language, okay? So while the above steps, they do stress the limiting language to minimize risk, you put those in there, there's certain additional limiting language that you might have to put in there. If you don't have to put it in there, again, you're going to see the language that I'm going to show you different examples of, you're going to see it's very, very harsh, but you need it at certain times. If you don't have to be as harsh, don't be as harsh. You still might want to get some of this stuff in there, but you want to be careful about how you put it in there, okay? So the letter that the steps I've done above, that already has enough in there for a client where you feel comfortable about the position, you feel comfortable about things, but again, this is to provide additional assurance. So I have some examples, some additional optional statements that you might want to use if you have very, very, very questionable situations. So limit the basis upon which the letter is issued. So this is if a client, for example, is going to give this to their friends, or they're going to have other CPAs look at this, other tax professionals, other attorneys. You want to definitely put additional limitation. It's already kind of in there. Okay, we've already said about being confidential, but you might want to put additional stuff. The opinions expressed below are solely on the representations you made in your letter to the undersigned dated month, day, year. Any deviations in facts from the statements made in that letter may result in material modifications to or revocation of the opinions expressed herein. Limit the person. So going on what I was saying, no other person is intended beneficiary of this letter. Any representation to the contrary are prohibited. Limit the person who may receive the letter or its contents. This letter may not be referred to, copied, quoted, or disseminated without the express written consent of the undersigned. Limit any opinions expressed to ascertainable standards. Therefore, based upon the stated facts and the relevant authority cited, a realistic basis exists for taking that blank deduction. So like charitable deduction, right? Let's say that there's a bunch of different issues in your memo that you had to deal with, and now you're writing the client letter, and you got to talk about all those things, and maybe the charitable contribution deduction is favorable for the taxpayer, but everything else is not tax favorable. You want to be clear that, hey, you have a reasonable basis for taking this deduction, but you don't have a reasonable basis for taking another deduction. You might want to limit it in those situations. Okay. In the example that we're going to do in a few minutes, where I write this from scratch, there's really only one major issue. I mean, there's different years at issue. There's not like a bunch of stuff going on. Limit any opinions expressed to the date the letter is issued. The opinions expressed in this letter are limited to those applicable federal income tax laws that apply as of the date of this letter. Future court decisions or legislative action may defeat the opinions expressed. Limits your duty. Actually, let me talk about that one. So that one, you might be saying legislative action may defeat the opinions expressed. It's not that common for for Congress to enact a law where it's retroactive, but it has happened. So if you do think something will become retroactively or go away because Congress, enacts a law, just be careful of that and make sure you put that in the letter, because again, you could be dealing with something that could open up the floodgates to potential liability through malpractice suits. Limit your duty to update the letter. The firm expressly denies any duty to update this letter for subsequent factual developments or changes in applicable laws. Describe clearly any conditions that the letter is based upon that have not yet occurred. So this letter and the opinions expressed are based upon your representation that you will form the corporation pursuant to all valid state laws and issue the shares in accordance with all applicable laws. That one I gave you an example. So let's say that a client's going to you and they're trying to form a business entity and they're trying to determine should they be an S corporation or a LLC, and you ultimately say, okay, S corporation for these reasons. So they're going to file a B corporation, but again, all this stuff is anticipated, hasn't happened yet. So if you were providing, okay, well, if you were an S corporation, this would occur. If you were an LLC, this would occur. And basically the idea at the end of the letter, if you recommend being a corporation, you're basically saying, okay, well, this letter and the opinions expressed are based upon your representation that you would form a corporation, valid all state laws, blah, blah, blah. Okay, and then limit the letter to your role as a tax professional. So as we know, accountants take different hats, valuation, attestation, different things. So if you're a CPA, for example, or you're an attorney, you need to limit it to your role as a tax professional, right? If you're a CPA, you're going to say this does not apply to attestation, to valuation services, forensic, whatever it is. If you're an attorney, only applies to tax, does not apply to, could apply just to civil, not criminal, just applies to tax, does not apply to property law, those types of things, okay? Finally, the last thing I want to talk about is what not to do when drafting the letter. And I mentioned this earlier, Canal Corp, the case where it presents an illustration of what not to do when preparing a tax opinion for a client. In Canal Corp, the client sought a tax opinion from an accounting firm on the merits of a transaction. The accounting firm provided its opinion. The IRS determined that the transaction did not have sufficient merit and disallowed it. However, the IRS determined that the transaction warranted the imposition of the accuracy-related penalty under Code Section 6662. In response to the taxpayer's argument that it reasonably relied upon the professional tax opinion on the transaction from the accounting firm, the IRS and the court both agreed that the accounting firm opinion was so far from an acceptable tax opinion that the taxpayer could not reasonably rely on it to avoid a penalty. So what they're basically saying is that the client letter that was written, this opinion letter written to the client, was just so far was not reasonable, and Canal Corp relied on it, and basically Canal Corp saying, well, even though it wasn't reasonable, the rule is, okay, I can still rely on my tax preparer or my tax professional that prepared this, and the IRS and the courts are saying, no, that's not the case. You still need to see if it's considered reasonable or not. And the idea here is that we need to basically avoid having an unreasonable client letter altogether. And the way that we do that, when you look at Canal Corp, and rather than spend several minutes talking about the Canal Corp, what they wrote, I kind of just summarize what exactly made it unreasonable. There are really 6 things. There were lots of typographical and grammatical errors. It was very disorganized. There were incomplete sections where they just would talk about things but not, finish them. Unreasonable assumptions were made, questionable conclusions, and equivocal language such as it appears or it seems was written, which we need to avoid. So all these things should be avoided. We shouldn't have typographical or grammatical errors. Should be organized, not disorganized. We should complete all sections, all discussion. That's why also at times it's really good to keep things maybe shorter and then put them, okay, we can talk about these in a meeting. Let's meet in person, look at the client file, or talk over the phone. Unreasonable assumptions were made. So, you want to make reasonable, not unreasonable assumptions. That was a big one, by the way. Questionable conclusions were drawn. We want to avoid that, and we do not want to use language that it appears or it seems, especially when you have unreasonable assumptions, questionable conclusions, all these things. If something is very clear, you can use that clear language, but if it's not clear, do not use, language like you will do this or you will do that, okay? Unless you put something in later that says, it's questionable, and you say, again, to kind of condition it. I know I said that was the last thing. Actually, the last thing is the disclosure dilemma, okay? So I have one last interesting little item to bring up, and that is I've gone through and I've talked to you about, disclosing information in the client letter, risk mitigation. One thing that I've yet to talk to you about is how much information exactly you want to provide the client. Okay. One thing I did say is that at times it should be shorter because you can always say, let's do a follow-up in a phone conversation, or through let's meet in person. I'll show you the client file. You can always do that. Risk mitigation. But some highly qualified tax advisors seriously question the wisdom of including any discussion of disputable points. Remember I mentioned there that if there's an argument on the other side the IRS can bring up, that you should bring it up? Well, that's what I'm talking about. Some tax professionals say do not put that in there. And the reason why is because it could end up being a document, the client letter could be a document that the IRS can get their hands on. Specifically, under Code Section 7602, the IRS has the right to examine all relevant books, papers, and records containing information relating to the business. Sorry, that should be information. I apologize. Information relating to the business of a taxpayer liable for federal taxes. Now, Section 7525 extends the attorney-client privilege to federally authorized tax practitioner, to a federally authorized tax practitioner in non-criminal tax proceedings before the IRS and federal courts. So basically, we have 7602 in the Internal Revenue Code, but then we also have this 7525 attorney-client privilege that prevents certain documents from being shared with the IRS or whatnot. So you have like this pool in both directions. One side says, yes, IRS can get everything. Other side says, no, IRS cannot get certain things. However, this privilege, the attorney-client privilege, does not apply to any communication between a CPA and his or her client if the communication would not have been privileged between an attorney and the attorney's client. So the question becomes, okay, well, a CPA gets the same privilege regarding tax matters, but it's only if an attorney would have gotten that to begin with. Case law supports that information disclosed to an attorney for the purpose of preparing a tax return is not a privileged communication. So that means that it does not apply to a CPA. So the IRS under 7602 can get the client letter, okay? It potentially can get to it. The accountant in tax practice is thus faced with a dilemma. If a client letter discloses both the strengths and weaknesses of a client's posture, the letter could weaken the client's position, okay? So specifically what I mean is, if you put in there, okay, well, this is ultimately what happens, and the IRS could argue this for these reasons, well, then the IRS could look at that, okay, they could argue this, and they could use that in their argument. So a lot of times people are like, well, we need to leave out a lot of stuff. The problem, though, is that if you don't bring up those things, you potentially face liability, so you have that risk mitigation. So if you don't bring up those issues, then the client's going to come back to you and sue you and say, well, you never brought that to my attention. If I knew about that, then I would have never put that down. So while some advisors disagree with me, I think the best approach, what would you rather do? Would you rather, potentially give the IRS the argument, or would you rather face liability? Again, the biggest thing, in my opinion here, is going to be risk mitigation. So I think the best approach is to put the information in there. And again, you can still restrict certain things by saying, okay, well, here's what the IRS could potentially argue on this side, make it very, very broad, not too in-depth about every little argument, or at least talk about the material arguments, and you could say, the rest can be discussed in person over the phone, and that would then protect that that element from the IRS getting that information. Okay, so that's really all I have for information about the client letters. Now what we're going to do is we're going to draft a client letter from scratch. Okay, we're going to draft a client letter from scratch. So what I want to do is I want to pull up a memo that I wrote in a previous video, and that is the factors memo I wrote. And that memo, we're going to use the 7 steps we talked about in this client letter and the materials, and we're going to actually write from scratch, a blank Word document. We're going to write the actual client letter together so you have that information. All right, so here's our memo. This is our factors memo that we completed, and we've got senior partner, tax staff, date is December 31st, 20X1, and the subject is Mr. Client's land sales. So I'm just going to read through the facts with you so you have an idea of what actually happened. I'm not going to read the entire memo. It's an 8-page memo. This was a long memo that we did together. This is the one where we went through the different factors tests related to whether the sale of property to Calvin Client, Mr. Client, was investment property or considered inventory and ordinary property. So there was the factors tests of whether a developer basically is treated as having investment property when they sell land or treated as inventory, those factors tests. So here's the facts. January year 1, Florida land developer Calvin Client purchased a 500-acre parcel of land in Florida for $1 million. December 1st, year 1, Calvin spent $200,000 installing sewer water lines and subdividing the land into 300 quarter-acre parcel home sites. Note that this is not meant to add up to 500 acres due to the acres needed for streets, public spaces, etc. For the next 2 years, Calvin devoted his efforts to developing other parcels of land and selling them. He averaged 10 lot sales per year for years 1 and 2. These were not part of the 500-acre parcel, and averaged 10 lot sales per year for the 3 years before year 1. In January year 3, Calvin sold 100 of the home sites for $1 million to a builder in one transaction. Calvin received $1.5 million in total proceeds that year from land sales, no other activity. Calvin then held off on selling the remaining 200 home sites as he speculated on a major future increase in value as there was a sudden economic boom. In years 4 and 5, Calvin engaged in developing apartment complexes for Capital City Construction Corporation, also known as 4C. December year 5, 4C made Calvin an unsolicited offer and purchased the remaining 200 home sites from Calvin for $5 million for construction of a large apartment complex. Calvin received $7 million in total proceeds that year from land sales, no other activity. Okay, and the issue dealing with this fact pattern is what is the character of Calvin's gain, if any, for the year 3 or year 5 sales of the home sites. So we had to go through, and in the memo I went through, I calculated the gain in the year 3 and year 5 sales of the home sites, and we determined the amount of gain going through code section 1001, all of that realized gain or loss, recognized gain or loss calculation, and then we had to characterize the gain. And we looked at, code section 1221, inventory, could be inventory because, basically Calvin is a developer of land, and we have to consider whether this was viewed as investment land because, at one point Calvin, speculated that it would go up in value, things like that. And what you find is that it's basically, there's all sorts of cases that view it as a factors test. And we found 19 different factors, A through S, that basically we went through those factors and we found 4 cases that have a lot of similarity but also some difference. And what we did was we created a table. Okay, in the middle we had Calvin's facts. We had 2 of those cases, ordinary treatment. And by the way, I used the tax software BlueJ Legal in doing this analysis and helping me with my approach that's using artificial intelligence. So basically what we did is the ordinary treatment, 2 of those cases of the 4 that I talk about right here. 2 of those ultimately resulted in ordinary treatment by the taxpayer in a similar situation where you've got a developer selling property, and then the other 2, capital treatment, okay? So we had to determine whether it was going to be long-term capital gain or it was going to be ordinary gain, okay? And what we found out is of the 19 factors, A through S, only 9 of them had differences. When I mean differences, you look at all 19 of these, holding aside the circuit, and see how the rows, certain rows like K and L, for example, have no difference. Everything is no for every single taxpayer, right? So that's not a factor where there's any difference. Well, of the 19, and a row where there is a red, that means there is a difference in at least one of the cases compared to our facts and all the other facts of the other 3 cases out there. So I would highlight in red a cell that provides a difference, and then that would be the 9 different factors where there are differences. So we focus just on those 9 different factors in making the decision, because if the other factors are all the same, then what would, what fact that doesn't really provide any guidance for us in terms of this case. We just focused on the 9 where there were differences, which helped us tremendously. We don't have to go through all 19, right? It saves us a lot of time. Still a long memo because it's still 8 pages. So we went through those 9 factors with differences, and we basically said, okay, this factor, and again, I cite the factors again. So for example, B was the property acquired in a single transaction. We talk about that. B was the property acquired in a single transaction. And I talk about, which of the cases resulted in it being a situation where, it was a single transaction, and then which of them was multiple, okay? So for example, cases 1, 2, and 4, single transaction. Case 3 was not. And the idea is that if it's multiple transactions, it looks more like it's it's not going to be capital. It's going to be more like inventory, because you're selling inventory multiple times during the year. And we do that with all the different factors. Go through, we compare, contrast, and we ultimately see, okay, well, for that factor, it leans this way. So of those 9 factors, in our situation, 7 of the 9 factors, I actually say it right here, weigh in favor of it being ordinary or being treated like inventory. We ultimately said, okay, well, this leans more towards being treated as like inventory and ordinary character, not capital. There's still some arguments to be made that can be capital, but much likely that's going to be ordinary. And by the way, that's also the argument that the IRS would prefer. They would not question that because it'd be more taxes that the taxpayer has to pay because it's a higher tax rate. I also talk about Section 1237, but you don't even need to mention that because really the factors test is what's key. And then we have our conclusion that I provide the amount of gain. In year 3, it's $600,000 and it's ordinary. In year 5, it's $4.2 million and it's ordinary. And therefore, that's a conclusion that we get to. So that information, what we're going to do now is we're going to take that and we're going to create a client letter. Okay, we're going to use that information to create a client letter. So before I go to the blank document, let's just recall the 7 steps. Step 1 is the addressor, the date, the addressee, and salutation. Step 2 is put in the objective and scope of the research. Step 3 is a statement of facts as presented by the client. Step 4 is a general summary of the research project results. Step 5 is the closing, including any references to any required follow-up meetings. Step 6 is put in a disclaimer statement. And then finally, step 7 is the signature. So we are going to start and go through each of these steps. We're going to go through them, and I'm going to bring them back up after we finish each step, okay? So we're basically going to go between the steps in the PDF here. We're going to go through the facts of the memo and the information in the memo that we wrote, and we're going to write on a blank document our client letter. All right, so here's a blank Word document, and step 1 is to do the addressor, the date, the addressee, and the salutation, okay? Now, just to recall, our memo is to Mr. Client, and we are tax staff. We were tax staff writing the memo, and senior partner is the one that's putting this all together. So this is going to come from the senior partner. Okay, that's another thing is that usually one of the shareholders sends this to the client, because those are the ones that usually send out the written thing on behalf of the firm to the client. Okay, so we need the addressor, the date, the addressee, and we need the salutation to Mr. Client. Now, I didn't give you any information in the memo about the name of the firm, the address of the client, so I'm actually going to make all that up. We do know we're in Florida, okay? We're in Florida. Mr. Client is based in Florida. We're just going to call our CPA firm, let's just call it, we're going to use CPAs here, okay? You could be an attorney too, but we're going to use CPAs. Lemon and Lime CPAs, and they're located in Miami. So we're going to say 1200 Citrus Avenue, right? You like that, right? Citrus Avenue, Miami, Florida. And let's do the central Miami zip code 331 31. Not an actual firm. Now we're going to do the date. So we're going to use the date of the memo. I know it seems a little ridiculous because, you obviously probably wait a few days after, the senior partner's probably going to be waiting after the holidays to view the memo and stuff like that. Let's just say that, unrealistically, senior partner views it, it's perfect, and senior partner wants to send it out that date. So that was December 31st, 20X1. That's the date of the memo. So next is the addressee. That's going to be Calvin Client. And let's say Calvin Client is very wealthy. And in South Florida, a very wealthy area is Palm Beach, the island of Palm Beach. So we're going to say it's where Calvin Client lives. I like to use tropical themes. So let's say Coconut. He lives on Coconut Street. So let's do 1111 Coconut Street. Right, got that tropical theme. Palm Beach, Florida. And the zip code in Palm Beach, Florida is 33480. Okay. And then finally, we want our salutation. So, dear Mr. Client. So just like that, that is step one. We have our addressor at the top, we've got the date, we've got the addressee, and we've got the salutation, dear Mr. Client. Okay. So now let's talk about step two. Step two, objective and scope of the research. So remember, this one, what we're doing is we're putting information about the agreement in which our firm, what they're doing, as well as the reporting the results of, if you're doing a tax research project, of a specific transaction. You also want to have some fluff language. So let's go ahead and let's do that. Now let's think about, we've already seen the memo, okay? We don't need to go back to the memo for this because we can remember, we've already looked through. If you need to go back, rewind the video, back to the memo where I talk about it, think about what exactly the memo dealt with, the issue. The issue was, what is the characterization of the sales of the land in years 3 and 5? So if you're talking about the agreement, the firm has agreed to determine the tax consequences of the sale of the home sites in years 3 and 5, and that's also what the results are going to be. So let's go ahead and write that up. So again, determine the tax consequences of the sales of the home sites in years 3 and 5. Okay, so I'm going to go ahead and start typing. This letter confirms the agreement in which our firm agreed to determine the tax consequences of the sales of the home sites in years 3 and 5. And I apologize if I'm trying to watch my grammar and punctuation. However, if you do catch me, I apologize. Obviously, I'm writing this, so there's a little bit of I'm writing this with you, using my language from the PDF as a way to keep me in balance. But if you do notice something is wrong, please don't jump on me or comment or anything like that. You obviously get it, right? You get it. Okay, so that's, first, again, you want to state that what the agreement is, what the firm is providing the client. This letter also reports the preliminary results of our investigation into the tax consequences. I apologize, I usually type a lot faster, but when you are doing a video and you're also talking out loud, it makes it a little bit slower, so I apologize. Of determining the tax consequences of the sales of the home sites in years 3 and 5. So notice I kept that consistent with above. We are pleased to be of service, this is just the fluff language, to you, and anticipate that our relationship will prove to be beneficially mutual. So again, you want that fluff language to make it seem, all happy. please feel free to call upon me at any time. Okay. I like to do justified. You can do whatever you want, but I like to do that. It makes it look nicer. Okay, so that is our step 2, the objective and scope. So again, just to review, this letter confirms the agreement which our firm agreed to determine the tax consequences of the sales of the home sites in years 3 and 5. You want to use that language to be consistent with what you're also going to provide results on. This letter also reports the preliminary results of our investigation into the tax consequences of determining the tax consequences of the sales of the home sites in years 3 and 5. Notice I use preliminary results, and the reason why is because if this is the first client letter we're writing about this project, if something does change or more information comes out, then of course it's not the final results. We are pleased to be of service. See, that's why we go back through this, right? Perfect example of us going back and doing grammar punctuation check, right? Very, very important in practice. We are pleased to be of service to you and anticipate that our relationship will prove to be beneficially mutual. Please feel free to call upon me at any time. So we got some great language in there to help balance out the harshness. Also, what I'm showing you here is this, and this is actually what I do when I write letters. I usually do it, I don't do it out loud unless it's like a really, difficult paper or I'm writing like a tax research memo that's difficult. I go through and I read it in my head just to make sure it makes sense. That sounds good. So that is step 2, boom, okay? Now what we're going to do is we're going to go back to the steps and see what step 3 is. All right, step 3 is to provide a statement of the facts as presented by the client. So this is very, very, very important. You want to make sure, you want to put a paragraph that basically explains why you're going to be doing this. You're talking about the facts of a certain event and why you're doing it, and then you actually want to put the facts in there. Now, we're actually going to copy and paste the facts from the memo, and then we're going to edit them to make them more stylistic for our memo so that it looks more direct to the client rather than just saying, Calvin Client in January year 1 purchased a 500-acre parcel of land in Florida. We're not going to say, we're going to say you purchased a 500-acre parcel of land in Florida, okay? So let's go ahead now. Let's go back to our blank memo that we're writing, and we're going to put in that paragraph that talks about why exactly we're going to need to go through the facts with you first. We need to talk about the facts of a certain event, and then we can go into the actual facts. First paragraph. Before stating the preliminary, and again, preliminary because it's the first time we're sending this letter, okay? So your first letter to the client, you can call it preliminary. Now, it's possible that when you're writing this letter, this might be the only letter you do because everything is perfect, right? You've got everything right in terms of the facts and everything lines up what's agreed to, but still it's preliminary, so you want to put that in there. Before stating the preliminary results of our investigation, so investigation is a good word to use for a non-tax person because the idea here is you're investigating into the consequences of them and they understand that. Just like if there's a criminal investigation, not that they're, criminal, but, there's just so much, criminal stuff on TV or, like CSI and stuff like that, or at least in the past there was, right? If you're watching this in the future and people just understand, they love investigations. It's just, it's like doing like a Sherlock Holmes, right? Investigation. Results of our investigation into the tax consequences, and we want to, again, use that same language from above, of the sales of the home sites in years 3 and 5. I would like to restate briefly all of the important facts as we understand them. Again, we, because you're on behalf of the firm, okay? So that's one thing to note in the letter is that there's times where I say me or I, and then like I would like to restate, but then you also say we, and if you were going back to your elementary, middle school, high school English class and you looked at it and your teacher saw this, they'd be like, no, you're saying I and we. The idea here is that you're talking, you are the one writing, but you're also saying things on behalf of the firm because it's, as you know, a firm is a collective we. Okay, we understand that. Please review, so this is putting, again, risk mitigation hat on. Please review this statement of facts very carefully. Our conclusions depend on a complete and accurate understanding of all the facts. So again, risk mitigation language, okay? That's what we're talking about here. It's the name of the game. If any of the following statements is either, so that's why we have a singular, just so you know, if any of the following statements is either incorrect or incomplete, please call it to my attention immediately, no matter how small or insignificant the difference may appear to be. So this has This has risk mitigation language all over it, okay? Okay, so now we're getting into the paragraph where we actually state the facts. Our conclusions are based on an understanding that and now we want to go to the facts that we put in our tax research memo, copy and paste them here, and we're going to edit them. Again, why have to recreate the facts again when we've already got the important facts from our tax research memo? So let's now go over to our tax research memo. Okay, we're back at our tax research memo. Here's the facts. I literally am just going to copy and paste. So let's just highlight these. We're going to copy, okay, and we're going to paste them now into our Word, our client letter, the Word document that we're preparing from scratch. All right, boom, just like that. Let's go ahead, paste. So we are pasting. Let's change it up, keep text only. Okay. So if you read through this is what I've been saying. You see it says Calvin Client. January year 1, Florida land developer Calvin Client purchased a 500-acre parcel of land in Florida. We need to go through now, and you'll see it's Calvin Client, Calvin Client. And some people might like to use the Control-F, the replace function, but you'll see it's written in a weird way. It's kind of weird, right? You don't want to say in January year 1, Florida land developer, you purchased a 500-acre parcel of land. So we just need to go through and just read this together and make it flow better if we're writing this to Calvin Client. Also, this is a really big paragraph, and I want to break it up, especially given there's multiple years. So let's make it multiple paragraphs. So in January year 1, Florida land developer Calvin Client, we'll just change that. We'll take that off, and we'll just put you. You purchased a 500-acre parcel of land in Florida for $1 million. See? Really short. So I want to be very concise. Okay. Also, another thing is that just as December 1st, Calvin spent, we'll change that to put in December of year 1. Again, you spent $200,000 installing sewer water lines and subdividing the land into 300 quarter-acre parcel home sites. Note that this is not meant to add up to 500 acres due to the acres needed for streets, public space, etc. We can take that out, that last parenthetical, because that was in there to help us understand what was going on. Okay? For the next 2 years, comma, Calvin, and that's where we can put you devoted your efforts, right? Again, that's why we're going through this, your efforts to developing other parcels of land and selling them. He averaged, that should be you, right? You averaged 10 lot sales per year for years 1 and 2. These were not part of the 500-acre parcel. That we need to keep in there, okay? Just to make sure that the client clarifies that. An average 10 lot sales per year for the next 3 years before year 1. So after that, we start talking about year 3. So I'm actually going to, and that's where we do our first sale, I'm going to go ahead and cut that as a paragraph. In January year 3, Calvin should be changed to you. You sold 100 of the home sites for $1 million to a builder in one transaction. Calvin received, that should be you received $1.5 million in total proceeds that year from land sales, no other activity. Leave that parenthetical. You, so Calvin should be changed to you, then held off on selling the remaining 200 home sites as you speculated, smart speculation, on a major future increase in the value as there was a sudden economic boom. Okay, now we're moving into years 4 and 5. So again, I'm going to cut that right there to make it flow better. In years 4 and 5, you, I know it sounds weird to keep saying you, right? You engaged in developing apartment complexes for Capital City Construction Corporation, 4C. We can leave the 4C in there because we refer to it again. That's fine. December year 5. Let's go ahead and put in December of year 5, right? In December of year 5. "4C made you an unsolicited offer and purchased the remaining 200 home sites from you, Calvin to you, for $5 million for construction of a large apartment complex." And then finally, Calvin, you received $7 million in total proceeds that year from land sales, no other activity. Okay, so we have finished step 3, which is to go through the facts. Let's just go ahead and read all of this now. I know this is a lot of information, but we're going to go ahead and read this again. We're going to read it out loud just to make sure it makes sense, okay? Before stating the preliminary results of our investigation into the tax consequences of the sales of the home sites in years 3 and 5, I would like to restate briefly all the important facts as we understand them. Please review this statement of facts very carefully. Our conclusions depend on a complete and accurate understanding of all the facts. If any of the following statements is either incorrect or incomplete, please call it to my attention immediately, no matter how small or insignificant the difference may appear to be. Okay, that sounds good. So now we're getting into the facts. Our conclusions are based on an understanding that in January year 1, you purchased a 500-acre parcel of land in Florida for $1 million. In December year 1, you spent $200,000 installing sewer water lines and subdividing the land into 300 quarter-acre parcel home sites. For the next 2 years, you devoted your efforts to developing other parcels of land and selling them. You averaged 10 lot sales per year for years 1 and 2. These were not part of the 500-acre parcel, and averaged 10 lot sales per year for the 3 years before year 1. In January year 3, you sold 100 of the home sites for $1 million to a builder in one transaction. You received $1.5 million in total proceeds that year from land sales, no other activity. You then held off on selling the remaining 200 home sites as you speculated on a major future increase in the value as there was a sudden economic boom. In years 4 and 5, you engaged in developing apartment complexes for Capital City Construction Corporation, also known as 4C. In December year 5, 4C made you an unsolicited offer and purchased the remaining 200 home sites from you for $5 million for construction of a large apartment complex. You received $7 million in total proceeds that year from land sales, no other activity. Boom, got it. A lot of stuff. We finished step 3. Okay, moving on, right? Got 7 steps. Now we're moving on to step 4. So let's see what our PDF says for step 4. All right, step 4 is a general summary of the research project results. So in this summary, what we want to do is we want to provide the conclusion that we came to. We also want to get a little bit into the details of how exactly we got there, if there's anything important to note. Also, if there's an argument by the IRS, if they're going to argue from the other side, we need to mention that as well. We talked about that earlier in our discussion. That's really the main things, okay? Also, we want to put this in layman's terms. Our client is not a savvy tax professional. It's Calvin client. Maybe Calvin understands business, but we want to talk about things in terms of preferential rates. We want to compare things to business income because Calvin is a business owner, understands wages, things like that. So we want to make sure that we put it in that manner. So what we're going to do now is we're going to go to our tax research memo. We're going to look at the conclusion again. We're going to look at some important information also in there about, how we got there, what we could say, keeping it very short and succinct, how we can say we got there, like why, what was the main aspect of how we got there, just to give them more information, give Calvin client more information. And then from there, we will go into writing it in our actual letter. All right, we're back to our memo, and I actually want to go to the conclusion first. So go to your conclusion. Calvin, more likely than not, must record ordinary gain in year 3 and ordinary gain in year 5 on each respective disposition. So we have ordinary gains in year 3 and 5. The ordinary gain in year 3 is $600,000. The ordinary gain in year 5 is $4.2 million. So I'll write down $600,000, $4.2 million, year 3, year 5. Okay, and it's ordinary. I can remember ordinary. Okay, one thing I want to note. As we know, when we're writing a tax research memo, we have the more likely than not standard. We put that in there. When you're writing to a client, don't do that. Don't put more likely than not. You have it in your intro memo. You can just put down, ordinary gain. You just put it down there. Again, if there's a questionable aspect by the IRS, you can say that, okay, it's questionable. The IRS could argue this. That says that there is doubt of what they potentially could argue, okay? Now, one thing to note is that this was not favorable to the taxpayer. We did not get to long-term capital gain, but it was pretty clear in this case that it was going to be ordinary, and the reason why is because, again, 7 of the 9 critical factors that we focused on where there were differences pointed towards ordinary character, and we need to note that to Calvin. We need to say that, because if Calvin wants to know, well, okay, well, why are you telling this is an unfavorable position? We can say, listen, there's 19 factors possible. Okay, and of the 19 factors, really 9 of those factors are the critical ones, and 7 of those 9 go in favor of being ordinary income. They weigh the scales, they tip the scales in the favor of ordinary income, and the other 2 factors that weigh in favor of capital were not super factors or anything like that. We kind of want to stress that. Maybe don't say super factors because that's getting a little bit too technical, but you get the point. Clients can generally understand factors. They understand factors. They don't understand what a factors test is in the tax law and how that works, but they get factors. They get that. So you can mention that in a factors test that there were many factors, and if you want to provide numbers, that provides even more concrete detail. Now, if the client wants to come to you and say, oh, you mentioned there's 9 factors and 7 of them pointed in favor of being ordinary rather than being capital, but how close were they? Were they really close? That's where, again, you say, let's talk about this. If you want further in person, on the phone, I'll be happy to do so. You don't want to put that in the letter in case, again, then you have risk mitigation issues. You have the IRS potentially looking at this and getting all that information because, again, we learned that the client letter is not really protected in terms of privilege, okay? Unless it was a criminal tax issue, but you would deal with an attorney anyways, okay? So let's go ahead and take that information. We're going to take that information now. We're going to take the conclusion. We're going to take this 7 of 9 factors of the 19 factors, 19 factors, okay, because there's 19 total here. And we're going to put that information into, there's a 19 here, A through S, just so you know. We're going to put that information into the memo. And you're going to see that we're also going to summarize things in layman's terms because, again, we're not dealing with a tax director or tax attorney as our client. So let's go ahead now, let's move over to our memo, and let's go ahead and do step 4 and talk about the ultimate results. All right, so we're going to start a new paragraph. We're going to start a new paragraph, assuming that the preceding paragraph, so we'll just talk about the facts, right? We need those facts to be set. Sorry, my spelling. That's why I love having spell check. Assuming that the preceding paragraphs of the facts, of course, right, represent a complete and accurate statement of all the facts pertinent to the sales of the home sites in years 3 and 5. Notice I'm keeping consistent with that. Sales of the home sites in years 3 and 5. I've used that throughout the memo. These events result in ordinary gains, or I should say, result in an ordinary gain. In an ordinary gain. We're going to break it out. I was going to do both of them together. And an ordinary gain of, in year 3 of, and the amount, as we saw from our memo, was $600,000. It was $600,000 and $4.2 million. $600,000 and an ordinary gain in year 5 of $4.2 million. And again, we'll go back and we'll review. Read this thing. In other words, the sales of the home sites result, and this is where we get into the layman's terms, results in gains taxed similarly to wages or business income and do not get the preferential long-term capital gains rates. Now I'm putting long-term capital gains rates in here because a lot of wealthier clients know about long-term capital gains rates because they know, a lot of them own stock. They sell their stock, right? They know they get the special rate, preferential rates. You can put in there, such as the sale on stocks and bonds that you hold for more than 1 year. This results in a higher tax rate applied to the year 3 and year 5 sales than if the two transactions were considered long-term capital gains. Okay, so basically we're saying, not done, but basically we're saying, listen, it's ordinary treatment of $600,000 and $4.2 million. And we're saying, in other words, ordinary just means that it's being taxed similarly to wages and business income and not like the preferential rates you get on when you sell your stocks and bonds, which, hey, Calvin Klein's a wealthy investor, lives in Palm Beach, sells stocks and bonds all the time, probably gets his preferential rates, knows that, hey, if you hold the stock for more than a year, you get preferential rates. They learn from their financial advisor over many years, right? So they know all this stuff. They know that already. That's something, that's a reasonable assumption that we know the client knows, preferential rates on that, okay? The distinction, sorry, I accidentally put my caps on. The distinction, they want to start yelling, the distinction between the transactions, so this is where we're getting now into, okay, well, how we got into the distinction. The transactions being treated as ordinary versus long-term capital gain is made by focusing on 19 factors. Note, we don't talk about cases. We don't talk about specific code sections. We just talk about, hey, there's 19 factors that make a difference here. 9 of those 19, we're not going to list all of them out. We're not going to waste the client's time. If they want to know them, they can talk to us later. 9 of those 19 factors were viewed as critical for this analysis. 7 of those 9 critical factors weigh the transactions toward ordinary income, and therefore these dispositions will be treated as ordinary income. So we kind of explained, okay, listen, there's factors tests, and again, clients, they generally get what a factors test is. They know that means there's multiple elements that go into the analysis. They get that. They don't know exactly what a factors test is, like we do as tax professionals, how like different factors could weigh differently depending on the courts. They don't get that, and we don't really want to talk about that. But they do know, okay, factors. They think about from a layman's, from a Webster dictionary, from a common usage, what factors are, just same way. So we can use it because that is how it's being used here. Basically, the distinction between being a long-term capital gain and ordinary, in this case, comes down to 19 different factors. Of the 19 factors, 9 of them we viewed to be critical here in this case. And of those 9, 7 basically said, oh, it's ordinary. 2 said long-term capital gain. So they can kind of understand, listen, it looks like it's very heavily weighted towards that. As we know, those 2 might be stronger, but still there's no super factor. If there was, we'd have to tell the client that, but there isn't one. So we don't have to put that in there, okay? So now what we need to do is we need to finish this off by saying, and again, this is what I always do, if you desire, I would be pleased, again, you want to put very friendly, cordial language in there, make it not as harsh. So again, with this legalese, I would be pleased to discuss these matters in greater detail. Perhaps it would be desirable for me to meet with you and review these potential problems prior to, we'll say, to you filing, I was going to say our filing the tax return, but we don't actually, we don't know if we necessarily are filing it for them, prior to you filing the tax return. Okay, so that's really everything. Let's go ahead and read it. Assuming that the preceding paragraphs represent a complete and accurate statement of all the facts pertinent to the sales of the home sites in years 3 and 5, these events result in an ordinary gain in year 3 of $600,000 and an ordinary gain in year 5 of $4.2 million. In other words, the sales of the home sites result in gains taxed similarly to wages or business income and do not get the preferential long-term capital gains rates such as the sales on stocks and bonds that you hold for more than a year. Let me make that a little bit clearer. Such as and do not get the preferential long-term capital gains rates you would get on the sale of stocks and bonds that you hold for more than a year. How about that? It makes it more clear. Better language makes it more clear. This results in a higher tax rate applied to the year 3 and year 5 sales than if the 2 transactions were considered long-term capital gains. So basically, I'm saying it again, so making it clear again, listen, it's a higher rate. The distinction between the transactions being treated as ordinary versus long-term capital gain is made by focusing on 19 factors. 9 of those 19 factors were viewed as critical for this analysis. 7 of those 9 critical factors weigh the transactions towards ordinary income, and therefore these dispositions we treated as ordinary income. If you desire, I'd be pleased to discuss these matters in greater detail. Perhaps it would be desirable for me to meet with you and review these potential problems prior to filing the tax return. Okay, perfect. Now, before we move on to the next step, right, that's step 4. We've got step 5, closing, step 6, disclaimer language, step 7 is the signature. I want to talk about if we were to say, okay, this results in long-term capital gain, you would want to put something in here that says there is a possibility that the Internal Revenue Service could argue that the sales of the property in years 3 and 5 could be ordinary gain, or what is ordinary gain. You would also want to explain, okay, well, I told you, let's say that this ultimately was 5 of the 9 factors resulted in long-term capital gain and 4 resulted in ordinary, and we concluded it should be long-term capital gain. So we say, okay, well, 5 of them weigh in favor of ordinary income. Of the 9 weigh in favor of ordinary income. And that's why we resulted, 5 of them, weigh in favor of long-term capital gain. That's why we came to the conclusion of long-term capital gain. You should put in there is a possibility Internal Revenue Service could argue that the sales of the year 3 and year 5 pieces of the sales in year 3 and year 5 of these lots could be ordinary gain because, well, there's still 4 of the 9 factors that are viewed as that weigh in favor of ordinary. That's what you would say if that was the case, but that's not the case here. You would want to put something in there about the Internal Revenue Service could make that argument. And that makes it clear to them that even though you're telling them that it should be treated as long-term capital gain, there's still potential it could be argued the other way by the other side. Okay, so let's now go back to our PDF and let's see what step 5 is. Okay, step 5 is closing, including references to any required follow-up meetings. So this is just going to be you're going to have some fluff in there. We're going to have some important legalese, some important risk mitigation language. Very important. Nothing from the memo we need. So let's go back to our drafted client letter. Okay, let's go ahead and start a new paragraph. Let's go ahead, again, this is our closing. We still have to put the disclaimer and the signature at the bottom, so it's not closing as in our last paragraph. It's our closing in terms of what's going on here in terms of what we're doing. So let's go ahead and write this. Thank you again for selecting, we want to put some fluff in here, selecting our firm for tax assistance. Again, you want to make sure that they have that relationship to come to you, whatever they need, come back to you. You need that fluff. It is very important that the material in this letter be kept confidential. You want to make sure that's in there. And we strongly recommend that you carefully control access to it at all times. If you have any questions about any of the matters discussed, feel free to request a more detailed explanation. And again, that's where you open up the door for a meeting or over the phone, or drop by and review the complete files. And they're always welcome to review those files. We look forward to serving you in the future, right? That's our conclusion. So our concluding paragraph. Then we have to do the disclaimer and the signature, but that's our concluding paragraph. So let's read it. Thank you again for selecting our firm for tax assistance. It is very important that the material in this letter be kept confidential, and we strongly recommend that you carefully control access to it at all times. If you have any questions about any of the matters discussed, feel free to request a more detailed explanation or drop by and review the complete files. We look forward to serving you in the future. Okay, so that is step 6, step 5, the concluding, jumping the gun there. That's step 5, the concluding paragraph. Now let's see what else we have to do, and we'll look at the last 2 steps in the PDF. Okay, our last 2 steps are the disclaimer statement, which, remember, your firms, your accounting firms, your law firms, your tax preparation firms, whatever you use, usually you have a disclaimer statement already to use, but I'm going to give you mine. I'll go through it in the, I'll write it for you. And then you have your signature, which is just, you putting your name, putting, the firm on behalf of the firm, that type of stuff. Okay, so let's go ahead and do step 6 and step 7 in our client letter. All right, let's start a new paragraph. And let's go ahead and do our final steps, steps 6 and 7, disclaimer statement, signature. So disclaimer statement first. So IRS regulations require us to advise you, and again, your firm probably has its own disclaimer statement, but if you need one, this one can work for these assignments. You probably want to make sure it's more compatible for practice, just so you know. To advise you that unless otherwise specifically noted, any federal tax advice in this communication, put a parentheses, including any attachments, enclosures, or other accompanying materials, was not intended or written to be used, and it cannot be used by any taxpayer for the purpose of avoiding penalties, semicolon. Furthermore, this communication was not intended or written to support the promotion or marketing of any of the transactions or matters it addresses. So that is our disclaimer statement. Let's go ahead and read it, just make sure it's all good, grammar, punctuation. IRS regulations require us to advise you that, unless otherwise specifically noted, any federal tax advice in this communication, including any attachments, enclosures, or other accompanying materials, was not intended or written to be used, and it cannot be used by any taxpayer for the purpose of avoiding penalties. Furthermore, this communication was not intended or written to support the promotion or marketing of any of the transactions or matters it addresses. Boom. Step 6, disclaimer statement. Finally, we get to the last part, which is the easiest part, the signature. So sincerely, we'll call ourselves Lemon, because we have Lemon and Lime CPAs, Lemon CPA, and we are the senior partner, right? And we put the name of the firm, Lemon and Lime CPAs, and we are done. So we have finished our letter. This is our client letter. So just to review, step 1 is to put the addressor, the date, the addressee, and the client's name. Step 2 is to put the statement of the scope and the objective. Step 3 is to go through the facts with the client, having that paragraph, making it clear what you're doing and that they need to clarify if there's any issues. So we did all the facts, and again, we copied and pasted and made it work better. Step 4 is to go through the client, the results of what we've done, right? If you're doing a tax research project, what you determined, the conclusion, and maybe a little bit, the conclusion and a little bit about how you got there. Step 6 is a concluding statement step 4 was, I just said that, sorry. Step 4 was the ultimate outcome. Step 5 is a concluding statement. Step 6 is the disclaimer statement, which most of you, if working at a firm, you have your own disclaimer statements you can use. And finally, step 7 is the signature. So I hope you enjoyed that. Again, we wrote it from scratch. You've got this now. If you're taking a tax research or tax writing class, you can use this approach to writing your client letter. One thing about client letters is they do differ by firm, but these are the elements that are in all client letters. I told you about, there's additional language you could put if there's special situations that merit additional limitation of language. So you can look at my materials, go back and look at that in the video. But if you are doing an assignment client letter, you should use this approach. If you're taking my class, you can just use the same language for the most part, changing it up for your assignment. I'm happy if you're doing that. Don't think it's plagiarism because I'm allowing you to do it because I want you to do well. I want you all to do well. So I hope you enjoyed this. If I can ever be of any help, please watch my other videos where I provide guidance on tax research and also tax writing.